Well, so I think one of the other things that you spend a lot of time doing, because like everyone's familiar with SaaStr, um, but they might be maybe less familiar with SaaStr Fund,
Yeah.
and the fact that you're a full-time investor, even though like a full-time investor plus a full-time media company impresario here. So I guess that's like maybe two full times, which is probably not surprising. But maybe what you can do is kind of like share a little bit about how you started kind of like doing investing
Yep.
and like maybe what inspired the SaaStr Fund and kind of how it's differentiated from kind of other folks out there.
Sure. I find a lot of this stuff boring, but I know people find it interesting. So I'll answer your question, right? So,
Gee,
uh,
thanks.
yeah. Well, it's just there's just I think founders should and executives should learn a lot about how investing works, right? There
Sure.
is there is it's just but my story. So yeah. So after I left Adobe, one of my investors, a fund called Storm Ventures, asked me to join. I went there. I worked there for 2 years, and it was a great opportunity to really learn to invest. And it went pretty well. So my first investment was Pipedrive, that ended up selling for 1.5
Nice.
billion. Yeah. My second
It was a
one was
Vista. Was that a Vista pickup? If
yeah, they
or
bought it for
okay.
cash. That was the first
Mhm.
one. So I learned a lot from that. The second one was Algolia, which is doing hundreds of millions and is worth 3 billion today, which will go IPO when we come out of this. Search as a service API. The third
Love
one
it.
was Talkdesk, which is worth 10 billion today. The fourth one is what became Greenhouse, which is worth about over $1 billion today. The fifth one was SalesLoft, which, as you know, sold for well over $2 billion last year, right? So I was kind of 5 for 5 in the beginning, and had a few other pretty good ones too. I actually you didn't know back then that they would be so good, but those ended up on the aggregate being fairly insane
Yeah.
outcomes. And then in 2016, I kind of struck out on my own for a variety of reasons. Got harder, but still done pretty darn well. And I try to do 3 or 4 investments a year of like 1 to 4 million. Um,
Hmm.
the world's changed. It got harder during the boom, right? From late 2020
Hmm.
to early 2022 when everything got insane. So I kind of slowed down a bit. And now I'm behind. I actually have too much money, as do some. I actually have, it's interesting for founders to be, I actually probably have too much money to invest now. And would love to do, 4 great investments in the first half of next year if I can find them. It's a really interesting topic. It may not be what you want to chat about of dry powder. There was a lot of
Yeah.
talk about too much dry powder. Now people aren't talking about it anymore because
Hmm.
VCs that do later stage stuff are just terrified.
Hmm.
They're terrified. But there's a lot of, for folks that have been around for a while, like me, here's something for founders to know. For folks that do seed, up to late seed, up to early A, folks that have been doing this I started investing in 2013. So anyone that's been doing it since 2015 or so, they're excited to invest now. Folks that
Well,
started more
valuations
recently,
are declined and so
it's
on and
not
so
even
forth,
just
right?
that. It's just like, it's still pretty good. Like uh, good companies today are still worth $5 billion. Like if you invest at 10 million valuation and GitLab's worth 5 billion and HashiCorp's worth 6 and Mongo's worth 8, you could still make money. So maybe not as much as last year, but so folks that have been doing seed for a while that have some had some returns, some hits, right? Yeah, maybe
Hmm.
they're worth half of what they were last year, but we know how to do it. But folks that started investing more recently, actually, no matter what they claim to their LPs, their portfolios may have like nosedived, right?
Oh yeah, definitely.
Um, but yeah, even with market adjustments, my current batch of companies is at 4.4x. So like that's still good. Like you can still make money if you quintuple your investors' money, right? So that's why hunt out investors now that have been around for a while. Hunt out investors that aren't scared. If you're early stage, they'll invest, but late stage, oh my god, I've been stunned the last 30 days how much worse, and I just wrote about it on SaaStr today, how much worse late stage investing is.
Hmm.
And this is why there's so many layoffs in the industry. It's not, sometimes these companies are struggling, but for the most part, CEOs are waking up to the fact that there's just no more money coming. That's
Right.
the issue.
Like
That's what's
yeah,
fueling
that
layoffs. There's
yeah, that
no
was
more
like
money coming.
yeah, well, like what used to be like, okay, this is good for 24 months.
Yeah.
Now it's like, nah, that actually might be enough for 36 months. It might be enough
No,
for 48 months. Yeah, it might be
it.
it. Right. So so exactly. So like just, rejigger, tune your spreadsheet, a little bit there and say like, oh, okay, gosh, like I guess we can't be that upside down right
We can't be
now.
that upside.
And
And then like
yeah,
and what if and then I can go back to the point. But basically, if you're wondering what happened in layoffs, like what Stripe said is like was transparent and true. Basically, everyone doubled their hiring last year. Everyone doubled their hiring. Um, and so best case, they're freezing hiring now because they don't need twice as many people today. And capital was so cheap and there was just so much capital that every VP was like, well, they hit this crazy plan. I need 100 more reps. I need $100 million marketing budget. I need 1,000 CSMs. And yeah, when capital seemed to be infinite, you just gave it to them. Right, you just gave it to them. But the thing is, people hired 50% more people than they needed last year. When I look at go back at the headcounts of the later stage companies I've invested in, all of them doubled their headcount. Even some of the most conservative and lowest burn ones doubled their headcount last year, and they didn't. No one needed to. Like, let's be honest, no one really needed to double. You do need to grow your sales team to meet your plan, but you didn't need. We didn't really need to double our headcount. It was too fast. It wasn't just the money. It would have been fine if we raised all the money and left it in the bank, right? But we didn't, right? We just doubled. We doubled the
well, but
headcount,
I think the
and we
problem is that
paid people a
every
lot more. And we paid
yeah,
people a lot more. There's a lot of inflation, especially in sales.
yeah, I think that like here's the thing. I think one of the things I've come to realize is like it's funny like there's like microeconomic actors, like people walking down the street making a decision as to whether or not they're like going to buy a hot dog or not. And then there's like macroeconomic actors, which is like Jerome Powell or whatever. And then there's kind of like medium economic actors, which is like startup founders and what have you. And I think the thing there is like everyone's got a boss, right? And I talk with my investors about this a lot, where like you raise this money not to just like have it sit in the bank, because your investors, you know, like the deal there was to deploy that to then turn it into ARR growth such that it could go to the next markup, such that it could impact their IRR, which is exactly what the LPs want, and so on and so forth. So I think you'd have to have had pretty strong intestinal fortitude to essentially make a trade like that and say, hey, I'm going to raise a bunch of money in these frothy times, and I'm literally going to sit on it Warren Buffett style and then wait to deploy it later on.
Well, you're
I
right.
I think I think that was like pretty.
Some did.
God,
Some
if you
did.
did it,
Some did.
I mean,
Some did.
high five to you, man. Like God
Um,
bless. But like those were probably pretty spicy board meetings while you were sitting there, like sitting on your cash pile.
they weren't spicy. I mean, I've got one I know that's actually really accelerated in the back half of this year that's sitting on 100 months of capital. When I just got right there, they're still burning almost nothing. Some did.
Awesome.
Um, and typically that happened when a company really didn't need a dollar and someone just
Sure.
offered to pay an insane price, and the culture didn't change. I think your point though is really important, which is part of the overhang is, you're right, is that at peak 2021 investors just told you to spend it all. Now, as
Mhm.
founders, it's your job to do the right thing. Like but literally the messages you got, to say they're 180 degrees from today would be an understatement. Like, I don't know what's more than 180 from like it's like in the
Upside
metaverse
down,
or something.
inside
And you
out.
go to a
Yeah.
board meeting now, and like no one really cares if you grow, if you don't, as long as you don't need any more money. But the advice was horrific at the time that folks got last year. Like, horrific advice was, no matter how fast you were growing, it wasn't fast enough. Spend more. And in all fairness, the public markets were reflective of that, right? The public markets only cared about growth, so VCs only did. But really, many of the best VCs did not give that advice. I did not give that advice. I didn't tell anyone to spend any more money. I told people the opposite last year. I'm like, this is as good as it will ever be in your lifetime. But yes, VCs are to blame for things today, but maybe not always for the knee-jerk versions you hear on Twitter. It's that toxic advice. They have to be held responsible for that toxic advice to spend it all.
Yeah, but I mean, like I'm not here to like be an apologist for for venture investors, because like Lord knows they don't need it, but their LPs were expecting the same sort of thing, right? And the
No,
same.
no, 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 no. If you really want to get into the atomic piece, yes, LPs did fuel it, but LPs don't care whether you deploy how much the company burns or anything, right? They just want strong, reliable returns. LPs did not are not really to blame for anything. And The markup activity you described is the one thing where LPs were to blame. Historically, in my investing career, LPs were always skeptical of markups. They always looked, and many funds historically in the old days didn't even do markups, right?
Mm-hmm.
And then markups became institutionalized. And what happened? But LPs will always be like, whatever. I remember when I raised my first own fund back in 2016, the LPs literally didn't care about anything. Like, it doesn't matter. I'm betting on the future, right? Markups don't matter. Companies go up and down. Companies raise at 100 or 200 and then fail. But then LPs last year all started to report it as is. Top LPs last year had 90% average IRR. So they got drunk on this too, and they fueled it, and they took this stuff seriously. But no, VCs do play to their own investors, but their own investors are one layer less in the weeds, right? They're less in the weeds.
Yeah. And so just kind of as we're kind of wrapping up on time here, Jason, when you say, so it sounds like you're saying that you have a bunch of, dry powder that you're sitting on, and you're looking for to make, generally you do 3 to 4 investments a year. What was 3 to 4 investments a year, 1 to 4 million, $1 to $4 million. Maybe you can kind of share a little bit about, like, how SaaStr Fund is like differentiated from other kind of early stage kind of seed stage
I don't think I'm
capital
differentiated
providers.
in any way, shape, or form. The only thing that's differentiated is,
tell me what you really think.
Is that you get me for better or worse, right? That's the only thing that's differentiated is me. I don't think that firms are differentiated that much. A little bit. Look, I mean, SaaStr is a decent brand even today, right? And that can help with recruiting, like people do like SaaStr, right? So it certainly does help to be, look, having Sequoia or Excel on your cap table helps, and whether it should or shouldn't, having SaaStr certainly helps with recruiting executives. It is a good indicator, and founders should seek that out. Like, at the margin, pick a brand, because each time you raise capital, you only get so much for that, but do the best you can with that slice. But the honest answer is, beyond a brand, you get me, and that's about it, right? And I have pros and cons, so you should. I only invest in founders that really, really want me. This is what I've learned over the years. And every month, I'll do a favor meeting. I'll get an email from another VC, be like, "Can you meet with this startup?" And I'll be like, "Do they know SaaStr?" And they'll be like, "Not really." And I'll be like, I really," and I'll do the meeting, and it just never works out, right? It never works out. All the ones I've done have been from SaaStr super fans. And if you are a SaaStr super fan and you've read SaaStr and you think my honesty and direct approach and the ability to help you recruit is what you want, then email me, like, seek me out. If you don't think that I could add any value, or maybe I add negative value, then do not seek me out. And that's cool. Venture is only so lucrative, and it's only so interesting. And I would rather do fewer investments with founders that want me than be out there. And, like, maybe to tie it together, venture is sales, right? And there's different sales strategies, right? And mine is 100% inbound. I failed at outbound as a CEO, and I failed. It is, engine. And I failed at outbound as an investor. Every outbound deal I've done, either one failed, and I gave up. And so I just wait, and hopefully each year, 3 or 4, a couple good founders, great founders, pick me. And if that's all you really have to do in investing, is, like, all the meetings don't matter. Nothing matters other than that a couple great people pick you. And I will tell you, I'll that's where I'm different. And, to finish the thread, if you're curious, like, you can meet 1,000 founders a year, or you can meet one. Like, the other ones don't matter. It's not a volume game. It's not. Tiger Global made it look like it. They had a good play, but really the great ones, in 20 minutes. In fact, you often know before you meet them. Not always, but often, right? The way they communicate, the way they share data, the way they share metrics, the way they share their vision. Not all of them, but so many of the best ones are so crystal clear on how they're going to get there, why they're going to get there. Those are the ones that you want to invest in, and those are the ones you want to work for as a VP or a leader. You want to work for the ones with that vision and the ability to express where they're going in a way that makes your jaw drop. And if you're not seeing that from your boss, find another boss, find another CEO to go work for, right?